Let's get right to the floor show and Brian Belski, Chief Investment Strategist at BMO Capital, who, by the way, just called out a new street high target for the S&P 500 of 6,100. Brian, 6,100 by year end, no less. What's behind this bullish call?
Well, thanks for having us. We actually wrote the report earlier this week and then waited for the Fed announcement and then published before the open yesterday, knowing that we would probably see some sort of volatility. And we did, a reaction first to the upside, then the downside, obviously right after the Fed announcement. And then yesterday's news, we were lucky enough to get the report out before that. But this is all part of our 25-year secular bull market call, Liz, that we've had in place since 2009. We're in year 3 as of next month of the new cyclical bull market. To us, this feels a lot like our early days in our career back in 1995-96 when we were this young strategist at a place called Dane Bosworth, when we were picking stocks and really liking the U.S. And I think that's where we are, especially given where interest rates are, this Goldilocks economy. We're going to have a soft landing, and we're returning to normalcy in terms of bond yields, earnings growth, valuation, and, yes, market performance.
Your last target increase was all the way back in May, so you're not one of these guys who's constantly switching. We know who those people are on the street, but you're very, very specific when you make these calls. But this one really requires a massive run-up by December 31st, so because we're at 5,600 at the moment. So give me a sense of which sectors you believe are going to get us there so our investor audience can maybe start thinking about adjusting their portfolios.
It does, and just to go back on the changing the target thing, the last time I did it and changed a target like this to the upside was 2009. So that really should tell you something in terms of when we were upgrading our targets in 2009 as the year progressed. But we continue to believe that when you see this type of move the first 9 months of the year, it's happened 8 other times in market history since 1950, where we've had a 15 to 20% move to start the first 9 months, and the typical rally from there is 6 to 7%. We think we can get a little bit more than that. Why? Because we do believe that there's going to be more money coming out of fixed income, more money coming out of private equity, coming into equities. Why? Because so many people missed this move, Liz. They're still negative. They're still thinking we're out of recession. And I don't know about you, but I'm not going to try to outsmart the Fed. The Fed's the smartest person in the room. They're saying soft landing. They're saying 2% inflation. They're saying still 4 to 5% unemployment. When you have 4 to 5% unemployment, that means 95% of the people in the United States have jobs. So that's not a recessionary environment. So I think this bull market is still relatively early, and it's all about stock picking, less about the overall market, Liz, but more about stock picking. So areas within financials and technology especially.
Well, let me get back to the original question, though. If that is the case and you are correct, which areas of investment will get me there? When I look at your breakdown, there's one area far and away that you are overweight, and that's information technology. 30% of the portfolio, you say, should be overweight there when it comes to technology. Why? After such a big run-up.
Well, there's two parts of that. For about 10 years now, we've talked about the big parts of technology becoming the new consumer staples. And you just talked a little bit about Apple and Mr. Cook in New York City. So we think Apple, Microsoft, Netflix, Google are your new consumer staples, where the opportunities, we think, from a fundamental perspective, is the next tier down. And that's why we've been adding more to our positions in Oracle and Palantir and AMD and Qualcomm. We think those are going to be the ones that really start to see a lot of leadership the next 6 to 12 months. From a financial perspective, we love the money center banks. We love the asset managers and the broker-dealers for the theme of scale, Liz. But we also really, really love the very small mid-cap banks because of the relationships that they've built and the trust they built with their commercial customers and their private customers. We think loan growth there is going to be very positive.
Okay, so the smaller regionals. I'm looking today at big financials, and they are in the red. Well, it's a mixed picture, really, but it's interesting to see, particularly if you stretch out the regional bank index. Let me just look at the KRE. We had it up there for 1 second. They've actually done pretty darn well this quarter. Quarter to date, up 18%. Brian, it's good to see you. Okay, he's calling for 6,100, folks. Remember the name, Brian Belski of BMO. We will be watching it, and we'll have you back before that for sure. Thank you.
Thank you.